Awesome. So people are coming in. And to everybody coming in, if I am having problems with my Instagram, so there are a ton of people who trying to watch and connect from everywhere. So if you are watching, just bear with me. Connor, I appreciate you hopping on, giving us the time. I know a lot of people will get some value out of this and hopefully can pick up on some things from here too. Connor, were you presenting today?
Yeah, so I do have a little something here prepared. We can give it a few minutes if you'd like to let people join in and get on the
Yeah,
call
because
here.
they're coming on from everywhere. We're going to be streaming for a couple places, and this will be recorded. So some people want to save recording. And then I shot you an email with some of the students in the mentorship, some of the questions that they had asked too. So hopefully that'll alleviate some questions, some common questions that people may want to know.
Yeah, we can. I left some time at the end. We can touch on those as well for sure.
Awesome, awesome. And then while we wait a second, how's everybody doing? Where's everybody coming from? If you want to put it in the chat, I'm excited to see so many people. If you have a question, just put it in the chat for us too, and hopefully we can get it answered. And again, Connor, I really appreciate your time. And I'm just gonna
Absolutely. And
out to
thank you
everybody.
for having me on here today, Ray.
Yeah, it's a great platform, man. And to everybody, I guess a lot of people from Canada, they might have saw me speak or might have saw my Instagram and saw it. And my biggest thing is help educate people. You know, a lot of people they make these investments or they want to make these investments and just aren't sure where to start. So that is my biggest position, is just to help educate people. I'm just gonna do a quick broadcast right now. Awesome. So the rest of the emails went out. So we should have some more people logging in. Like I said, they're logging in from everywhere. And of course, of all days, we have this great class that we're hosting, and my whole Instagram goes down. We have no idea what's going on, but I will get it fixed and we will figure out what's up. And again, if you folks want to leave your whatever where you're from, go ahead, put it in the chat. We love to hear. Okay. And I know a ton of people were messaging me about the link. So, and if you have questions, you guys said you saved some room for the end just for some Q&A.
Yeah,
Awesome.
absolutely. So save your questions. We'll go through a lot of information throughout the webinar here, and then at the end we'll go through a few questions. And I know Ray had saved up a couple questions as well, so we'll touch on those at the end.
Awesome. Okay. Well, if you guys with no further ado, thanks for everybody for joining. Good to see so many faces, some familiar faces. And Connor, Evan, if you want to tell us a little bit about, your group and your accounting services and what you do.
Absolutely. So first off, thank you again, Ray, for having us on here today. We met a few weeks back at the multifamily conference, and immediately saw some value in doing something like this and getting some information for everybody on cross-border investing, specifically real estate investing, for Canadians and getting them started in the US. So I'm part of an accounting firm based out of Winnipeg, Manitoba, up here in Canada. We have a few of our members on here today: Evan, Julian, Kaylin. I see you guys. So they're all part of our team. We all kind of work in different areas, have different specialized skills that we bring to the table. So for myself, I specialize in cross-border taxation, in the real estate side of things as well. So I'll put my contact information up here throughout the presentation as well. So if anyone wants to connect, after the webinar, feel free, reach out to any one of us. We have information on our website. You can give us a call, send us an email. We're always happy to help. So without further ado, I will start sharing my screen here. All right, so as I mentioned here, we'll be talking about some US real estate specifically for Canadians. As I mentioned there as well, here's my contact information, so feel free to take a picture of that if you'd like. But I will be putting it up at the end of the presentation as well for all of you who may miss it. Before we get started too far, I always like to put a bit of a disclaimer here. Taxes can be complicated. And every individual situation, your situation should be evaluated individually and separately. Our goal here today is to provide you with some general information to get you started, but please talk to your advisors about your situation. What we're doing here is, again, providing you some general information. This is not specific financial advice. A quick overview of what we'll be talking about here today. We'll talk about a bit of bookkeeping. It may get overlooked from time to time, but it is quite important in getting started. It's quite important in the tax process, structuring your portfolio, etc. So we'll touch on that. We'll talk about structuring your real estate in Canada, as well as how your rental income is taxed here in Canada. And then we'll move into structuring your real estate in the US. We'll talk about the tax filing process, both in Canada and the US. And we'll talk about how those both interact with each other and how they affect one another. We'll then talk about a few risks that are present as in cross-border accounting here and cross-border taxation. And then, as I mentioned too, there will be some time at the end for questions. So we'll try and breeze through this to leave enough time for that. But first, a little bit about who I am here. As I mentioned, I'm with an accounting group called Grenier Group CPA. I'm a senior manager here, and I specialize in cross-border taxation and real estate. I am from Winnipeg, but I actually lived in Wisconsin for 4 years. So I do have some lived experience with the cross-border world. Two questions that I often get asked by people is, who do you work with and what do you help them with? So I work with all sorts of different clients, ranging from athletes to business owners, individuals, and investors, both US and Canadian residents. And their situations could be anything from someone who's planning a move across the border to someone who is planning on investing in real estate. Whether you're working in the US or in Canada, there's always situations that present themselves that you might need some specialized information. So then I provide everything from consulting on these situations. I help people who are planning on, again, investing and setting up structures in real estate, people who are planning a move, as far as going then for tax preparation. So I can prepare US tax returns, Canadian tax returns, and then plan that whole process out for you as well. On top of that, just given my area of expertise here, is I do have an extensive network of professionals who maybe have expertise in areas that I don't. So immigration, for example, I have many immigration lawyers and specialists in the area if you are looking for that cross-border expertise. Oops. So with that being said, let's jump right into it here. Let's talk a little bit about bookkeeping. And bookkeeping, it's crucial. It can be overlooked, but without quality bookkeeping, we can't provide any sort of analysis on your portfolio, any sort of tax planning, or even preparing an effective tax return. Bookkeeping is the foundation of all of this. We talk a lot about having a data-driven analysis, a data-driven approach. Without quality and timely bookkeeping, we cannot have that data-driven approach. So we need accurate records. And that goes for analyzing properties, creating a tax plan, or creating a tax structure across the US and Canada. And then on top of that, bookkeeping must be up to date. So if you are not up to date, you can get caught in getting behind on your taxes. You can get caught in not having up-to-date information to make those educated decisions. So very important that it's accurate and up to date. And then another area, again, that often gets overlooked is CRA and the IRS. They do review your tax returns. And if we know what's going on in your return, if you know what's going on in your return, we still need the paper trail to show that to CRA and the IRS. So quality bookkeeping is essential to respond to any of these reviews. Now we'll talk, like I mentioned, most of the presentation here today, most of what we'll be talking about is structuring your real estate portfolio. And this is often what I find is the biggest hurdle for people to get started. So in structuring any type of business, there's three areas, there's three things to consider that are the main areas, the main benefits of a business entity. And that is the tax treatment of the entity, the liability protection that you may or may not receive, and the maintenance costs. The maintenance costs are ongoing costs, such as legal fees and accounting fees that, again, are an annual basis that you have to, you incur these costs every year. Now, there are startup costs associated with many of these structures, but the maintenance fees is something that we want to consider. Other things that we will consider, again, there's a balance between each of these three areas, and then we'll look at some other considerations to try and find that balance that works best for you. So we look at things like the size of your business, do you have any investors, are you raising capital, etc. So a few of the property or a few of the entities that we're going to look at here, both in Canada and the US, we'll work at filling in this chart throughout the presentation, is a corporation, a partnership, just holding the properties individually. And then in the US, we'll look at C and S corporations, LLCs, and again, individuals. And we'll go through the different areas to consider, the pros and the cons of each. And again, please note, we can actually use a combination of these entities. So the first thing that we have to look at is how is rental income taxed in Canada? So if you hold property in your personal name, it's quite simple. Your rental income gets taxed on your personal tax return, and it's taxed at your marginal tax rate. So whatever your marginal tax rate is, that income will be adding to your taxable income, and it will be taxed at that appropriate rate. Inside a corporation, it's a little bit more complicated. It can be taxed in one of three ways. It can be taxed as active income at either the small business rate or the general rate. We aren't going to jump too far into the difference between those rates. It's a little bit outside the scope of what we're looking at here, but just know that rate is 9 to 31%, depending on the province that you're in. Lastly, it is in a corporation, rental income is taxed at about 50% if it's classified as investment income or passive income. That's very important to note, and that is generally how it's taxed in a corporation, is at that 50% rate. If you have a partnership, your rental income flows through to each partner. So you can have individual partners, you can have corporate partners, and that income will be taxed according to whatever the partner is. So now, I mentioned that in a corporation, you can talk about passive income or active income. So this depends a little bit on what services are being provided above and beyond the traditional rental services. So traditionally, obviously, the tenant is paying a rent and they are getting a place to stay. If you want to turn your passive income into active income in Canada here, we need to provide additional services such as cleaning services, security, meal service, etc. And usually we need to see employees. We need to see full-time employees to consider the income active. Usually this is around 5 employees, and CRA is very strict on these rules. If you have a passive investment in a real estate, it can be very difficult to classify that as active income. Because of this, rental income in a corporation is generally classified as passive, and it's taxed at 50%. A quick example of the difference here is a traditional apartment building compared to something like a nursing home, where now you're providing more services above and beyond just the traditional rent. So now we'll go back to our table here and look at some of the pros and cons to each structure. So looking at the tax rate here, again, corporation we touched on is 50% tax rate generally. Your partnership will be either the marginal tax rate of the personal or the individual who is a partner, or the 50% rate if it's a corporate partner. An individual, it will be taxed at their marginal rate, as we mentioned. Liability, this would be your exposure if something happens, if you get sued, if you have creditors coming after you. In a corporation, that liability exposure is limited to your initial investment. A partnership, again, it depends on if the partner is a corporation or an individual, and an individual has unlimited liability. Our maintenance costs for each, corporations and partnerships both require year-end work. Generally, financial statements will be prepared as well, and they require a separate tax return. So because of this, the maintenance costs are fairly high for both of them. For an individual, it would just be the cost of your individual tax return. So maintenance costs would be a little bit lower. I put medium up here. Again, we still advise, we still recommend work with advisors, work with a professional. So there still will be some cost, but they will be much lower. And finally, some ideal usages for each of these entities. Corporation is if you are an active real estate business, if you're looking at limiting your liability, or if your personal income is already being taxed at 50%. So if you're already in that top tax bracket, you might not be saving any tax by not incorporating, by keeping your rental income on your personal return. As a partnership, it's ideal to use this if you are a larger operation and multiple owners, or if you're having if you're using a GP and an LP. So if you're raising capital, if you have multiple people taking part in a project, that's when you can use a GP and an LP and use a partnership. For individuals, it's best to use this if you have a smaller operation. Again, because the liability is unlimited, there is some risk here to not using a corporation. So I quickly want to touch on the tax rates in Canada here. We're talking a lot about tax planning. We won't spend too much time on this slide here, but again, please note, these are the Manitoba tax rates. And as you can see here, the top tax rate is 50%. So if you are at that $246,000 personal income, at that point, you will not see a benefit from keeping your rental income or your rental property on your personal tax return. And at that point, you definitely should, look at incorporating because you won't be saving any tax on the tax rates there. I also want to point a bit of attention here to the capital gains rates. So there was a recent change proposed in Canada to capital gains. So these rates are not updated for that change. We're not going to talk too much about that here today. Just again, please note that these rates are not completely accurate, as they may be changing here coming up. We're going to move into the US now, but first I want to reiterate the areas to consider when structuring your real estate business. So the tax treatment, liability protection, and maintenance costs. And those will still be true even in the US, even with the US entities. So in the US, there's three main structures that we look at. The first is a corporation. There's two types of corporations available. One is a C Corp, one is an S Corp. C Corps have a very high level of regulations and complexities, and they're subject to double taxation, so they're not usually a great option. And S Corps, you must be a US citizen or a legal resident of the US, so again, not a great option. Sole proprietor, so this would be similar to in Canada, just keeping your rental property on your individual tax return and holding it personally. The big issue here is there's unlimited liability, and in the US, there's a greater risk of liability exposure. So there's a greater chance of being sued. There's a greater chance for, there's a greater need for that liability protection. So being a sole proprietor with rental properties is not your best bet. Finally, there's LLCs, limited liability company, and this is a great option it's generally the best option because it provides you with liability protection. So the way this works is it's a flow-through entity. So the income from your LLC will flow directly to your personal tax return, and it will be taxed at your personal tax rate, so your marginal tax rates. And LLCs can have multiple owners. So if you are looking for some investments, you can still have that. You can still facilitate that. Now, again, moving back to our table, now we can compare each of these structures. So we can look at, our C Corps and our S Corps first. The C Corp tax rate is 21%. The S Corp is a marginal rate as it's a flow through. All the income will end up on your personal tax return. Liability is limited. I'm just going to skip down to the bottom here. The C Corp is very complex. It's useful for large entities. In a situation like this, it's not something that we would want to consider. And an S Corp, again, we can't have foreign owners, so this is not something that we can consider either. Next, I'm going to skip the LLC, come back to that in a minute, and we'll talk about holding your property as an individual, as a sole proprietor. So this gives you the tax benefit of being taxed at your marginal tax rate. However, the liability is unlimited. We briefly touched on this already. This is an issue because there is more risk in the US. There's a greater need for liability protection. So this makes being a sole proprietor unattractive for the business of rental properties. Maintenance is medium, but again, unlimited liability is a big issue here. So now we'll talk a little bit about our LLCs. Your LLC, you'll be taxed at your marginal rate again. The income flows directly to your personal tax return. However, the liability is limited. So this gives us the benefit of being protected from exposure, protected from creditors. So this is the big benefit here. And the maintenance isn't too high either. This can be included, your LLC activity can be included on your personal tax return, which keeps costs down. The cost to maintain this is much lower than a corporation. It's generally about $100 a year just to file a couple forms for the LLC, and then your personal tax return as well. So going back to the ideal use for an LLC, it's generally for Canadian investing in the US. There are many benefits of an LLC and many different areas to use it. But we're just going to focus on, Canadians investing in real estate in the US. So this is generally a very good option. I do want to point out again, we can use a combination of these entities. So as Canadians, what we could look at doing, is having an LLC in the US, and then a corporation, for example, could own that LLC. So a Canadian corporation could own the US LLC. At that point, that's when your business structure starts to get a little bit more complicated. And there's a lot more to consider with that. So that's where we would want to have a bigger conversation about what that means, about what the purpose of it is, and if it's going to give you a benefit. But just be aware that that is an option. So now let's touch on the tax rates in the US for a little bit here. I've been talking a lot about the marginal tax rates, your personal marginal tax rates, but what exactly does that mean? So in Canada, we know our tax rates are fairly high. In the US, as we can see here, they're much lower. Again, note these are only the federal tax rates. We'll talk about state tax rates in a little minute, or in a couple minutes here. I'm not going to go through every line. I'll let you kind of take a look at this table for yourself, but just note the highest tax bracket here is at 37%. And that tax bracket for 2024 starts at about $609,000. So it's quite a difference from in Canada here. So when we're talking about flow through entities, when we're talking about LLCs and the income flowing directly to your personal tax return, These are the tax rates that you'll be paying at, depending on where your income lands. As a Canadian citizen, your US income is the only income that will be reported in the US. So whatever your rental income is, that will likely be the only income that's being taxed in the US. So you could figure out your tax bracket accordingly. Now we'll look at the state tax rates, and these are can be a little bit more complicated depending on the state that you're in. Some states don't have any state income taxes, which is great for an investor. Some states do, but they only tax certain types of income. Certain states only tax interest income, some tax interest and dividends, others tax only capital gains. So what's important for you to note here is when you're looking at investing in the US in real estate, make sure you do your homework on the state that you're investing in. Does the state have state taxes? If so, does the state have income taxes or capital gains taxes? These are some of the questions that you'll need to ask yourself when you're looking at properties and when you're trying to decide which state to invest in. So now we'll talk a little bit about the tax filing and how that works. So now you have, let's assume you've gone with an LLC in the US, you have your rental property, you have income coming in. How do we treat this? So first, this income, it's US sourced income, it will be reported and taxed in the US first. You would file a 1040 or a 1040 NR for a non-resident. This is just a personal tax return in the US. This is the name of the form. If you have a corporation, you might have to fill out an 1120. Again, for our purposes, we're not going to jump into that too much now. We'll just focus on the personal side, the 1040. So again, you'd report that income in the US and you'd pay tax in the US on that. Assuming that you are a resident of Canada, however, the income still needs to be reported in Canada on your Canadian tax return. This is because as a Canadian resident, your worldwide income is taxed. And this is consistent as well. If you're a US resident, your worldwide income would be taxed in the US. So now a question I often get asked is, am I paying tax twice on my US income? Right? So if I pay tax in the US first, and if I pay tax in Canada, am I paying tax twice? And the short answer is no. You may pay tax in Canada as well, but you're not paying double tax. You're not being double taxed on it. So we can claim the taxes that were paid in the US as a foreign tax credit in Canada. And an oversimplified explanation of how that works is, let's say, for example, you pay taxes in the US at 10%. If your tax rate is 30% in Canada, you would claim the 10% of taxes that you paid in the US, and then you would have to pay the difference to CRA in Canada. So you'd be paying roughly 20%. So we still have to pay, unfortunately, the Canadian tax rates, but you're not losing out. You're not paying tax twice in that income. And that's an oversimplified explanation, but that should give some type of idea, that this is an option. You will still have to pay tax in Canada, but you're not being taxed twice on it. A few strategies that we can use to reduce the taxes that you're paying is the business structure, as we talked about. We might not want to incorporate in Canada because you'll have to pay taxes at that 50% rate. So evaluating your needs and picking the right business structure can help in reducing your tax. Depreciation. So this is a strategy that can be used to reduce your tax liability. We're essentially claiming the cost of the building as an expense over the life of the building. And in the US, they have a very good option. It's called a cost segregation study. So what we can do with that is if you get this study done, we can classify your investment. We can classify your real estate property differently depending on what the study tells us. So This essentially lets us claim a different rate of depreciation and claim more depreciation in the first couple years. This would give us a bigger benefit upfront, and reduce your tax bill earlier, so then you can start cash flowing the property. The US also has asset exchanges. So if you sell a property in the US and you buy a similar property, we can classify that as an asset exchange rather than a sale. So this is an area, again, there's a lot of details that we need to look at, but an exchange of this nature can help us avoid paying capital gains taxes. So rather than selling a property, recognizing a gain, and buying a new property, if both properties are similar and if they meet certain criteria, we can do an exchange. So it's a sale and a purchase with no capital gains. Obviously, there's some risk involved, right? So if you're investing in real estate, if you're investing in a business, there will always be some risk. As a Canadian investing in the US, there will be a higher level of risk. There's a number of reasons that cause this rather. The first is whenever you report foreign income and foreign taxes in Canada, you're more likely to be reviewed. There's many reasons for this. CRA cannot verify any foreign taxes on their own, so they like to review it to make sure that it's accurate. This review, going back to the bookkeeping that we talked about, if you're keeping proper records, if you're keeping all of the information that is required, and I always help my clients with this, I always talk to them about these risks ahead of time so that when they get the proper information, when they get letters from the IRS, they're holding on to them. So if they get this review, we can easily respond to it, and then there's no issues from it. However, these reviews can cause significant problems. So if the review is not responded to properly, CRA can actually remove the foreign tax credit from your tax return. And I've seen situations where clients have owed $100,000, $140,000 to CRA because these letters were not responded to. It's something that we can fix. So in the long run, we ended up getting that situation fixed for that particular client. So it was fixable, but again, it is a risk and it is something that you need to be careful of. Make sure you're keeping proper documentation so we can respond to these reviews. With investing across the border, there's just going to be added complexities. This creates inherent compliance risk. So if you have LLCs, if you have corporations, if you have partnerships, there are more forms to fill out. There are more tax returns to fill out. And with all of these forms and returns, there's more risk that if it's not done accurately, there could be penalties, there could be interest, things like that. So that's why we always strongly recommend work with a team, work with advisors. And when you're working with these individuals, make sure you plan with them ahead of time. So it's always easier for your team to create a plan and then for you to go and implement that plan rather than for you to just go and do something and then try and go backwards, try and work backwards. So when investing in the US, as I mentioned, there is a risk. There will be a risk. That risk can be mitigated, but it has to be planned. You have to create a plan to mitigate that risk. So again, work with your advisors, work with your team to make sure that you're aware of the compliant risk and that you're protecting yourself from it. Naturally, there will be foreign exchange risk. So with the currency, it can be volatile from time to time. Once you get established, this risk is a little bit lower because you will be cash flowing. Once you're cash flowing, you're not dealing with the exchange as much. As a matter of fact, you can actually capitalize on the exchange. Excuse me. You can capitalize on the exchange by using it to your advantage. But as you get started, as you enter the market, it is something to be mindful of. If you're putting Canadian dollars into US investments, your purchasing power with your Canadian dollar is much lower. So something to be aware of there. There is an increased liability risk in the US too. We briefly touched on this earlier. In the US, there's a higher chance of being sued. There's a higher liability, you know, healthcare costs are higher if something happens that you're liable for. So this is something that you need to be aware of, and that comes back to our business structures again. Creating the proper plan, picking the proper structure to reduce these risks for yourself. And finally, FAPI, foreign accrual property income. So I'm not going to get too far into this one. This gets a little bit more complicated, but the idea with this is that if you are sheltering money, if you're sheltering your investments in a US corporation and you are deferring taxes on your passive income and you're trying to avoid paying tax in Canada on that income, CRA can actually assess you on that income and make you pay tax on the income, even if you haven't received it. So again, that's something to be mindful of. It's something to talk to your team of advisors about if you start to get into LLCs and corporations and different business structures. Be aware that FAPI is something that you should be asking questions about. So a quick overview here. You know, I know I went through that fairly quickly. I want to leave enough time for questions. But investing in the US can create several risks that must be considered. So these risks can be reduced, but there is risk, right? At the end of the day, there is risk. And that's why you need to lean on people around you, lean on people like Ray, who have invested in the US, who he's opened up many properties. He knows the risks. He knows how to use an LLC to mitigate some of those risks. Your US rental income will be taxed in Canada as well, but it's not subject to double taxation. So that's something you have to be mindful of too, right? Is if your rental income is flowing through to you and you are recognizing that as income, it will be taxed in Canada, and that's something you have to plan for. You need to plan to pay for those taxes. And again, we have that foreign tax credit that we can claim. We have depreciation that we can claim to reduce the tax liability. But if you are recognizing income, you need to be ready for the tax bill. And finally, talk to your team of advisors. Talk to Ray. He knows how to, like I said, utilize an LLC, how to structure things in the US to set yourself up for success. Talk to your accountant about the tax implications of what's going on here. Make sure you surround yourself with people that are experts in their field and can set you up for success. With that being said, please feel free to contact me with any questions. I'm happy to do a 15-minute discovery meeting free of charge with anyone who has any questions, anyone who would like to, speak with me. The idea of the 15-minute discovery session is for us to get to know each other a little bit better and to determine what the next steps are. We may decide that you don't need help right now, but we'll then stay in touch as we move forward, as you move forward and look at properties in the US, and then we can talk about consulting at a later date. You might need help with tax preparations, tax planning. The goal of that 15-minute discovery meeting is to determine what the next steps might be. If you already have a project in the works, if you already have a plan, and you're looking for a little bit more in-depth help, a little bit more specifics, you can also book a 30 or a 60-minute meeting with myself, and then we can talk about how maybe some of these business structures that we talked about today, how they might fit in your individual situation. So again, there's my contact information. You can take a picture of that if you want it for the future. And then the QR code on the right there, that is a QR code that you can use to book a meeting with me directly. You have the option to book a 15-minute free discovery or one of those other meeting options as well. And again, I'd be happy to answer any of your questions. I think I left enough time here for any of your questions today. I noticed there's some in the chat here too, so I can start going through some of those.
And then Connor, if you had time, if you want to get to, because I want to make sure we get to the questions from the students in the mentorship too.
Okay, so let's do that first then. Do you have those questions or do you want me to pull them up?
If you can pull them up, might be best. Or
Okay.
I can go through them actually. Let me see if I have it available. Yep. Okay,
Okay,
so
I have them here. Oh, you got them?
yeah, I got them.
Okay, perfect.
Awesome. So one of the students asks, what are the negatives about investing in the US tax-wise that you would see?
Good question. So the negatives is it's more complicated. There's more risk that comes with investing in the US because it's more complicated. Um, Specifically, the liability protection is more important, right? So there's more liability exposure in the US. That is a risk. And then as well, just the structures can be a little bit more complicated depending on how big you're trying to scale. So um, if you're getting into it as an individual and you're going to open up an LLC and the income is going to flow to you, um, that's a little bit more simple to manage. If you're looking at raising capital, if you're looking at scaling to a size where you're going to have multiple investors, that's when your business structure might get a little bit more complicated, and that's where there's going to be more risk, or that's where there's more negatives, right? It really just comes down to the complexity that you want to make. We can keep it simple. There is a way to keep it very simple. Like I said, there's options there. If you're trying to make it a little bit more complicated, that's when that's where I see a negative, right? Is because of the cross border, there's more things to consider. I think that's the biggest negative, right? Is there's more things to consider, and then there's fewer people that can help with this type of work. So if you invest in real estate in Canada, lots of accountants can help you with that. If you're investing in a cross-border situation, there's fewer. There's still cross-border accountants out there and people that can help. It's just harder to find. Those are a few of the negatives that I would see.
Okay, we appreciate that. You might have answered this. What is the percentage rate tax in investing in the US with rentals for like a Canadian? So if they got,
So flip back here. So it would start with your federal tax rates in the US. So you'd be taxed at whatever your marginal rate is. Again, this is assuming that it's a flow through entity, an LLC that you're using. You'd be taxed at your tax rate here, plus any state taxes depending on your state. Again, if you're a Canadian resident, you would have to then report this income in Canada too, and you might be subject to your personal tax rates in Canada, which will be up on the screen now for you. So it depends. It will be taxed your marginal tax rate, and then again, it depends on depreciation. So depreciation is a very, very powerful tool that we can use. If we are claiming depreciation, it can have an effect on the taxes you pay when you sell the property, but it can help in lowering your tax bill today.
awesome. Um, and that was the next question. What is the percentage I will be taxed on if sold? So that was one of the questions that they asked. And I guess it comes down to the sale price too. That's a big determination factor as well.
Exactly. Yeah. So it's sale price and then your cost basis. So whatever you paid for the property is your cost basis. But then if you're claiming depreciation, you are essentially lowering your cost in the property. So that when you sell the property, now you're going to realize a larger gain. There's a few other technical components that I won't get into today, but that's the general idea of how the capital gain would be calculated, and then it would be taxed accordingly. Again, there's the capital gains rates in Canada that I mentioned, with the potential changes that have been proposed. And then in the US, again, it's taxed a little bit differently depending on the type of asset. Generally, it's taxed around 15%. But again, that depends on your depreciation and your cost.
And this was I think people may know this. I think I may know, be familiar, but there's no maximum amount of properties a Canadian can hold. I don't think
No,
there's anything in the US stopping us. So,
no,
um,
no, that's correct.
And what about they want to, and one, this is a very general question about partnerships in the US. So, say somebody was to partner with somebody who already owns, property in the US or is looking to buy something in the US already from here. How would that look like? Or what would that look like?
So there's a few different ways that we can structure that, right? We can look at um, having an investment. So you can have a general partner and a limited partner. You can both, if someone already has an LLC, you can create a new LLC for the new property. So for example, if the person you're going to partner with already has an established portfolio, you can establish a new LLC with this person that you're, maybe 50% owners of. And that would be the LLC that you purchase property through if you're buying it together. There are other ways as well. You could just put cash into a deal. So now you're a limited partner. For that, you don't necessarily need an LLC because your exposure is already limited. So it depends on how you're trying to partner with somebody. So there's a few different ways. That's again where I would talk to somebody, talk to your advisors about how does my situation and my goals, how does that impact my options, and how does that affect what I have, what my options are, and what's available to me.
Yeah, I appreciate that. And now I know we have some questions in the chat. If we want to go through those, let me see, Keith. If a Canadian has a U.S. family member, i.e., their child, and you can't, of course, you can't give advice, of course, but would you advise against creating a company in the U.S. by putting the company and their child's name to minimize tax liability?
So I think that depends. Again, it depends on what your goals are. So if you have a child in the US, they could theoretically have a corporation then. But if they have that corporation, if it's a C Corp or an S Corp, there are some benefits. But generally, the LLC will give you that liability protection. So you may not need to utilize that child to open up a corporation. So my first recommendation would be look at the LLC and what that provides you. If maybe you're trying to do something that the LLC doesn't work well for that, is then you can start to look at other options. But that's where I would lean on your advisor, lean on someone who's been there.
Yeah. Abramax, how can you borrow your income from your LLC so you don't have to pay yourself and pay taxes? I think he's thinking about leveraging some money from an LLC. Is that what it sounds like, Abram? If you want to clarify that too, or if you get the gist of it, Connor.
Okay. So yeah, so I think if you're wanting to leverage, there's different ways that you can do that with loans. You can take out loans against different properties. You can take out loans against different investment accounts that you may have. If you're talking about pulling money out of your LLC just to use personally, that money is essentially your money as is. So it's being taxed on your personal return already. So once you pay those taxes, you can spend it however you want. It doesn't have to be stuck in your LLC.
And question, I think I get what he's saying now. If he bought let's say he purchased a property at $1 million, and he refinanced it as new debt, I think that would be the gist is what he's getting at if pulling that money out so you don't have to pay taxes. I want to get to some more. Hopefully I answer your question, Abram. And are you able to use registered funds to invest in the US without having to cash them out?
Good question. So you can use registered funds if they are registered in the US. I don't believe you can pull out, for example, an RRSP to do that. So that would be something if you're seriously considering doing that, reach out to me and we can talk about this further. There are a few options that may be out there, but it might depend on the situation. It might need a bit of digging on our part. So yeah, answer be it depends, but reach out to me if that's something that you're seriously considering, and we can talk about that a little bit more.
Love that. And guys, we're just gonna try to get some more questions in because I know you guys sound very valuable. Make sure you do book with Connor and Evan, and make sure you book with these guys because they are a wealth of knowledge. Nadia asks, are there any advantage to purchasing U.S. property under 100K per person for Canadians? What about,
Yeah.
vacation properties and exemptions or advantages there for Canadians?
So the 100K is interesting. So there is another, I mentioned previously, the compliance issues that you need to be aware of. So if you purchase property over 100K, there's another form that needs to be done, which is just part of that compliance that we talked about. So the advantage to purchasing something under 100K per person would be then you don't have to fill out that form. Whether it's vacation property, it's all pretty much treated the same. So if you buy a property in the US and use it as a vacation property, if you are renting it out when you're not using it, it's still treated as a rental property. You only can claim a portion of the expenses then for the portion that is a business expense. When you're using it personally, you can't use that portion of the expense. So it depends a little bit what you're using it for.
Awesome. And Alex asks, what strategy change if you are investing, if you're an American residing in Canada and investing in the US, would the strategy change?
That's a good question. So if you are an American living in Canada, you actually have to file a tax return every year already. And this tax return is the same tax return that you would file as a resident of the US. So the strategies might change a little bit when we're looking at foreign tax credits and income that's being reported, because now you have to report, if you're an American, you have to report all of your income in the US, not just your rental income. So there would be that aspect that we would want to look at and plan around.
Awesome. Um, and then final question, do Canadians incorporate before purchasing a first investment property? Do you need a few properties under your belt before you incorporate?
Good question. So it depends how you're trying to balance those three criteria that we talked about, right? So um, if you're trying to minimize your tax bill, incorporating might not be the best option because you're going to be paying 50% tax on that property. If you have your, if you have your mindset on incorporating to limit your liability exposure, then you should incorporate before you buy your property and then buy it through the corporation. If you don't, though, there are ways that we can move property into a corporation. So it depends a little bit on your situation. I would say before you jump into incorporating, talk to an accountant, talk to your advisor about if it's the right move for you.
Awesome, awesome. And again, if you folks have questions, hopefully Connor has answered. Connor, you've done fantastic. I know you've brought everybody here a ton of value. If you want to put that up real quick, just in case anybody missed it one more time, Connor. And to anybody who wants this, we will be sure to send it out. And it's great that you're offering a free 15 minutes. I know the people in mentorship, people, in my program definitely appreciate that and appreciate all the value that you brought today tremendously. And again, if you guys want to reach out to them, his information is right here. Come highly recommended. I can't give you a higher accommodation, and we appreciate the time that you spend and the value that you bought.
I appreciate that.
Yes, yes. To the people in the mentorship, if I've left my email in the chat. For something's going on my Instagram. I know a lot of you get a hold of me on my Instagram. We have something going on my Instagram. So just send me an email if you need just a direct message and that'll work. And again, thank you so much, guys. I really appreciate this. I know taxes for some can be like very daunting, or for some could be very boring. So I know we really appreciate the time that you've taken to help educate people in the space. And I know to the people looking to invest in the United States, you've brought a ton of value, and hopefully we'll continue to bring a ton of value to them.
I appreciate that. I want to add on to that too, is like you said, taxes are boring for a lot of people and they're a headache for a lot of people, but they are very important, and it's a cost that is one of the biggest costs that you have in your life. So make sure you plan accordingly, and if it's not something that you want to deal with, make sure you build your team accordingly as well.
Very good. I'm sure these people will be very happy to have you on their team. All right. Well, thank you again, ladies and gentlemen. It's a pleasure having everybody on. Connor and the whole team, thank you. And we will see everybody next Tuesday, 6:30 Eastern Standard Time. Thank you, guys.